Welcome to The Explainer. Sometimes the market just screams its intentions at you. Today, we're going to talk about a trading signal that does exactly that. It's all packed into a single candlestick, one that shows pure, unfiltered conviction.
So, can a single day of trading really predict where a stock is headed? It's a huge question, right? But believe it or not, there's a pattern out there that tries to give a super clear answer. Let's dive into one of the most powerful signals in all of technical analysis. So, here's what we're going to cover. We'll start with why a single candle can be so powerful. Then we'll meet the star of the show, the Marubozu. After that, we'll get into the nitty-gritty, how to trade both the bullish and bearish signals. And of course, we'll talk about how to avoid the common traps and wrap it all up with a handy checklist.
Okay, let's kick things off with the basics. We've got to start with the foundation, which is this really simple but powerful idea that the action from just one day of trading can actually give us a pretty strong clue about what might happen next. And the big takeaway here is that not all trading days are created equal. I mean, look at this. A long candle, that's telling you a story. It's a story of a fierce battle where somebody won, decisively. But a little short candle? That's just indecision. It's the market shrugging its shoulders. So right away, the size of the candle is our very first clue. All right, now let's get to the main event. It's time to meet the star of our show, a pattern with a pretty memorable name, and trust me, an even more memorable look.
So, here it is, the Marubozu. The name actually means bald in Japanese, which is just perfect. Think about it. It's a clean, solid block. There's no hair on top, no hair on the bottom, no wicks, no shadows. What you're looking at is just pure, raw price action from open to close.
And this pattern comes in two flavors, polar opposites. You've got your bullish Marubozu, which is just a signal of pure, unadulterated strength. The stock opens at its low for the day and closes at its absolute high. Then you have the bearish Marubozu, which is the exact opposite, pure weakness. It opens at the high and just gets crushed all the way down to the low. There's no guesswork here. It's black and white. Okay, before we jump into how to trade this, we got to cover 3 golden rules that apply to pretty much all candlestick patterns. Rule 1, buy strength, sell weakness. You want to go with the flow. Rule 2, be flexible. Real charts are messy, not like the textbooks. And rule 3, this is a big one. You always have to look at the trend that came before the pattern. But, and this is what makes the Marubozus so special, it's the rebel. It's the one pattern that basically throws rule number 3 right out the window. The signal is so powerful, so definitive, that it doesn't matter what the prior trend was. A Marubozu is like hitting a giant reset button on market sentiment. Okay, enough theory. Let's get practical. How do we actually trade this thing? Let's walk through the exact setup for a bullish signal, step by step.
To really get this, you have to understand the psychology behind it. A bullish Marubozu isn't just a green candle, it's a statement. It's telling you that from the moment the market opened, buyers were in total command. They bought at every single price point all day long and never let the sellers get a foothold. That kind of overwhelming force suggests that the bullish feeling is probably going to stick around.
And the trade setup itself? It's beautiful in its simplicity. You're basically looking to buy right around the closing price of that strong Marubozu candle. You're just trying to ride that momentum. And the best part? Your risk is crystal clear. Your stop loss, your emergency exit, goes right at the low of that same candle, nice and clean. So the big question is, when exactly do you pull the trigger? Well, this is where you have to know yourself as a trader. Are you a risk taker? Then you might jump in on the same day, right around 3:20 p.m., trying to catch the best price. Or are you more cautious? The risk-averse trader waits. They wait for the next day, and they only buy if that next day is also bullish. You're trading a better price for a little more confirmation. It's a classic trade-off. And I have to be absolutely clear about this. No pattern, not even this one, is foolproof. They can and do fail. That's why your stop loss isn't just a suggestion, it is your ironclad safety net. If the price drops below the low of that Marubozu, you're out, no questions asked. Taking that small planned loss is the only thing that saves you from a massive, devastating one. All right, now let's flip this whole thing on its head. Everything we just talked about works in reverse. We can use the exact same logic to find an opportunity to short a stock, to bet on the price going down. And here you see it. It's the perfect mirror image. A bearish Marubozu shows total capitulation. It's the buyers just throwing in the towel. From the very start of the day, sellers were in charge, hammering the price down, 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 all the way to the absolute low at the close. It's a huge red flag that sentiment has turned really negative.
So the short selling setup is just as simple and logical. You'd look to enter your short trade right around the closing price, near the low of that candle. And your risk? It's perfectly defined. Your stop loss goes at the high of that Marubozu candle. If the price rallies back above that level, the trade is wrong and you get out. And just like before, that risk-averse option is still on the table. Remember rule number 1, sell weakness. A cautious trader will wait for a second day of weakness. If the selling continues the next day, that's their signal to jump in because it confirms that the bearish momentum is for real.
All right, so knowing how to trade the pattern is half the battle, but honestly, knowing when not to trade is just as important. Knowing when to just sit on your hands, that's what really separates the pros from the amateurs.
And here's the thing. With these candles, size really matters. A tiny little Marubozu, it might not have enough oomph, enough conviction to be worth trading. But what about a gigantic one that stretches across your whole screen? Well, that's a different problem. Now your stop loss is a mile away and the risk is just way too big. This chart really spells it out perfectly. You're looking for the Goldilocks candle. If it's too short, less than a 1% move, you ignore it. If it's too long, say over 10%, the risk is probably too high. You want the one that's just right, something in that sweet spot that shows real conviction without making your stop loss ridiculous. Okay, let's bring it all home. We're going to pull everything we've just talked about into a single, simple checklist. This is what you can use step by step to find and execute this trade. And there you have it. It's all right here. First, you spot the bald candle. Easy enough. Second, you check the length. Is it in that Goldilocks zone? Third, you set up your trade. For bullish, you buy near the close with a stop at the low. For bearish, you short near the close with a stop at the high. Fourth, you decide, are you jumping in today or waiting for tomorrow? And finally, the most important rule of all, you stick to the plan, no matter what.
And that's really what it all boils down to. You've got the strategy now, you have the complete plan, but the real question is, do you have the discipline to actually follow it? Because a brilliant strategy is absolutely worthless if you don't have the discipline to stick to the rules, especially the one about taking a loss. That right there is the secret to making it in this game.